The cost of living crisis, the energy crisis, I'm pretty confident you've already heard these terms because it's crisis mania. The UK, for example, has been experiencing an energy crisis contributing to what is now a cost of living crisis. This energy crisis has ultimately been a key factor in the huge inflation jump in the UK, and if we cross the English Channel and look at France, for example, between August 2020 and August 2022, household energy prices increased by a whopping 37%. Russia's invasion of Ukraine has led to disaster for energy markets around the world, and Europe's reliance on natural gas from Russia has led to this ridiculous energy crisis, which is now more than a year old. Whether you're a homeowner, a bill payer, or just a Stoic finance viewer, you have likely noticed that energy of all forms has gotten a lot more expensive. But now let's add to rising inflation, a looming banking crisis, and this stormy recession, and Europe looks like it's in for a monetary roller coaster that won't be at all fun. It tells the tale of what we have all suffered over the past few years. Recession risks have also been reignited by the banking crisis, as the World Bank now warns of a lost decade of growth and the arrival of a credit crunch. Over recent weeks, all eyes have been laid upon the global energy markets, trying to determine exactly what's going to happen and what it means for us. And as we all know, the conflict between Ukraine and Russia has been a key factor in the energy crisis in Europe in particular. Despite the sanctions set by the EU in retaliation for the invasion, Russia has made hundreds of billions of dollars by selling natural gas and oil to the West, but this is finally starting to slow down. The EU is now trying its hardest to diversify away from Russian energy, from using liquid natural gas imports from Qatar and the US to ramping up domestic production from other sources of energy like wind, solar, and even holding back the decommissioning of nuclear and coal power plants. Although Europe's political determination and economic resilience is being tested by the ongoing energy crisis, it's clear to see that the energy war between Russia and the West is not going to end anytime soon, and it looks likely to stretch beyond the coming months. The West put into place a price cap on Russian oil, which took a long time to prepare, and while it seems like it may have had some success early on, we've now seen that Japan broke ranks with the West and bought Russian oil at prices above a cap that they themselves instituted. At this point, it seems Russia has been able to find buyers for its oil, most notably in Asia, but it's been forced to sell for prices well below market rates, sometimes by as much as 30% below, damaging their revenue streams. The drama behind this energy crisis reached a peak with the Nord Stream sabotage, where unknown actors laid explosives and blew up both pipes in the Baltic Sea, and the finger seems to be pointing at America. It's clear today that Europe's energy market is never going to be the same as it was a few years ago. Never again will Germany so willfully import so much natural gas, and energy security is suddenly an important thing for every country to consider. And while the EU may not have frozen this winter just gone, next winter might not prove to be so warm, and so the risk is very much still alive. But in the end, things for Europe were actually okay. We may have made it out of the potential frozen winter, but what is coming next? Gazprom's CEO cautioned that even if Europe's maximized their gas reserves for the winter just gone, that households still risked freezing during a cold snap. Sure, Europe will survive, but what will happen when gas injection into storage occurs before the winter of 2023 and 2024? In the end, Gazprom, Putin, and all the other Russian pundits were wrong. They claimed Europe would certainly freeze, that people would starve in their homes with infrastructure unable to function. They claimed this would ripple out across the continent and drive a revolution that would force the West to soften their stance on Russia and abandon their support for Ukraine, but none of that happened at all. And now we've started to see gas prices fall insignificantly compared to the start of the winter. Governments like the UK, which had to jump to the rescue and subsidize energy bills for millions of households, are now pulling back their support under the belief that consumers can now weather that storm on their own. There is a chance that things go poorly next year though, as 2022 was an unusually mild winter, which certainly played into the West's hand, but we can't guarantee good weather forever. The EU knows this, and they truly are rushing to get things sorted, but this takes time. Infrastructure is not something that can just be magicked out of thin air, and it's taken decades to build the current systems which now all need tearing apart. New nuclear plants have been commissioned, which promises to fix all our woes, but these will take decades to actually start producing energy, and this is where the problems start up again, because this crisis is not going to end anytime soon, and it could be about to get a whole lot worse. Between April April and October of last year, OPEC Plus, a cartel of countries that produce a majority of the world's oil, declared that they would be reducing supply in an attempt to prompt prices higher and generate them greater profits. This was as a result of oil prices beginning to fall, which they had been doing steadily for months at that point. They spiked initially for two reasons in the first place: high demand thanks to the rebound effect of COVID lockdowns, and supply uncertainty thanks to the Russian invasion. But as the picture got clearer, it became easier to price into the markets what would happen with Russia and Ukraine, so those supply threats have been subsiding, and the rebound boom after the end of lockdowns has slowly evolved into a slow but sure recession, with demand for everything reducing, most notably oil. Biden and many other governments obviously wanted low oil prices, so they started flooding the market with supply, forcing oil prices down, and this essentially evolved into a soft and slight war between oil producers and oil consumers, both seeking the opposite outcome. For a while, things were quiet, and many thought that this conflict had fizzled out, that the energy crisis was solved, that all was well with the world. But then a couple weeks ago, we got news from OPEC Plus that they would be cutting oil production again, and prices would once again spike. They're going to be reducing their output by more than 1 million barrels a day, and analysts are now expecting oil prices to rise back above $100 a barrel. And to top everything off, Europe and the West has tied itself to the noble idea of net zero and green energy, which is one of the reasons they're in this problem in the first place. The simple fact is that the cheapest energy around today is not the cleanest, so if a country wants clean energy, that also means expensive energy. Should Europe refuse outright to invest in the most stable forms of energy generation, and we have then the chances of a truly frozen winter. It's clear that worldwide energy markets have been shaken over the last year, and it's also clear that they're not about to settle down anytime soon. Higher prices mean higher revenues, and those countries which rely on this income to keep the lights on, well, they're not going to let something as pesky as a global recession force their natural resource prices down. At the end of the day, this is why Russia has been throwing the energy security of Europe into shadows over the last year, and it's why OPEC Plus just announced they would be reducing their output of oil. High energy prices means higher revenues, and this is bad news for many people out there, but it does present investors with an opportunity, and not really in the way you might think. When it comes to Europe in particular, the focus is distinctly on natural gas. It's what the infrastructure is set up to run, and while not necessarily good for the environment, it strikes a strong balance between value and efficiency and not being too polluting. And this has been the case for years, and for years natural gas flooded in from Russia, but obviously since the Russian invasion of Ukraine, everything has changed. Now the EU is doubling down on natural gas as long as it doesn't come from Russia. They've even gone through and changed the narrative so that natural gas is now considered green energy to help drive more investment into this space to try and increase supply. And what kind of investment might that be? Well, this video's sponsor, MCF, is a prime example. MCF is the first new public company offering investors exposure to European gas since the outbreak of the war in Ukraine. Their team has deep expertise in European energy and a great track record in capital markets. They have at the moment two key prospects with potentially more on the horizon too. The Welschau prospect is in the foothills of the Austrian Alps, and MCF can earn up to a 40% interest here. And the Rudnitz prospect is about 50 miles from Berlin in Germany, and MCF can earn up to a 50% interest here. I expect this to be about a 12-month investment play, as the business is currently looking to capitalize on Europe's need to shore up their energy security over this coming summer. The winter just gone was unusually warm and gas demand was far lower than expected, but the EU can't always count on being this lucky. The team behind MCF has a brilliant track record. The CEO, James Hill, led exploration for Bankers Petroleum, which grew oil production in Europe by 2,000% and reached a peak market cap of $2.25 billion. Co-founder Ford Nicholson has helped create, manage and sell several large energy companies, including Bankers Petroleum, and Director General Wes Clark, who was the Supreme Allied Commander for Europe of NATO from 1997 to 2000, is on board after working with this team on Bankers Petroleum too. These guys have great connections and a track record of performing really well while working together. And for anyone who has watched this channel before, you might remember that in late 2021, I sold out of American equities in their entirety, and the only stock I owned throughout 2022 was a British energy firm that has since increased in value by about 20% while returning me 6% in dividends. One of the main reasons I invested into that company was because it had political protection. In the UK, offshore wind farms are loved by every political party, and so the only real question when it comes to the companies running offshore wind is, will they have favourable rules or very favourable rules? And this has proven to be a very solid investment for me at a time where indexes have fallen by about 20%. It probably isn't too surprising then that I've been looking for more opportunities in the energy space, and MCF presents a really good opportunity to capitalize on the changing energy environment in Europe. Natural gas produced within the EU itself has the potential to see that same sort of political environment and support for that industry. No party or country is going to complain about cheap energy coming from within their own borders, creating jobs and helping to end the energy crisis, especially as Russian gas is a no-go forever at this point for the EU. MCF have already performed really well since their IPO, and of course past results are not indicative of future performance, but they have so far risen by about 200%, and as they raised 50% more cash than they targeted, they're going to be drilling and acquiring more opportunities and assets. Of course, there's no such thing as a free lunch, and there is no investment without risk, but MCF are well capitalized. They had a brilliant fundraise that saw them overcommitted by 50%, and they benefit from first movers advantage here. If you're interested in them, they're trading on the Toronto Stock Exchange and their ticker is MCF. It's a speculative play for sure. Make sure you do your own due diligence, utilize proper risk management, and don't go throwing your entire life savings into this company after watching this single video, as nothing you see on YouTube is ever real financial advice. But MCF does have the potential to be a really solid pick going forward throughout this year.